Joining us now is Potomac Wealth Advisors President Mark Avallone. Mark, we're going to get to the broader markets with you, but look at those gains. We're not picking on those stocks, and we're not suggesting anything other than they were the ones that were down huge. A lot of concerns about their going business in some cases. Now they're getting back 50% in a matter of days. I could point out travel and airline names the same. I could point out, by the way, companies that have filed for bankruptcy whose stocks are up 100% in a day. What do you make of the last few sessions market action? Even though I know, Mark, you're not a short-term swing trader, I just want to get your opinion on it.
Well, I think the short-term frenzy to buy stocks reflects greed, some froth in the market. Look, there's an expression, greed eventually replaces fear, and that's what we're seeing now. 2 months ago, people were appropriately concerned that there was a structural breakdown in those sectors that you mentioned, and they priced them with a lot of uncertainty. And now they're being priced as if there's earnings clarity and market certainty, and there isn't. And that's what concerns us, not only about those sectors you mentioned, but even to some extent the market overall.
Yeah, I'm going to pick on Hertz for a second. I highlighted this, as did many others yesterday. JCPenney, some bankrupt oil companies like Whiting, but Hertz, HTZ, the stock more than doubling yesterday. It is now higher than it was before it filed for bankruptcy. It is the #1 traded stock on Robinhood. Think about this. When you file for bankruptcy, your equity almost always is worth exactly nothing. And yet traders are bidding the stock up to where it was before it filed for bankruptcy. What do you make of that?
The same exact greed eventually replacing fear, Brian, and that is not a strong underpinning for the market. Look, we've been saying for some time that this rally is a little overheated, and we have been, I don't want to say wrong, we've just been early. There's a ton of money on the sidelines. It's chasing stocks. I get that. There is no alternative. That's courtesy of Jerome Powell and the Fed. So if you have money, you want to put it to work. Bonds are not, they're not unattractive from a credit risk standpoint at this point, but from a yield standpoint and from a cash flow standpoint, you can do better in stocks. So I think that some of the flows into equities is justified. But I think the frenzy that you're talking about, the frothy stuff, the incredibly high multiple, chasing bankrupt companies, that's not what a strategic investor should do. As you noted, there's a difference between tactical investors who are looking for short-term trades, which is very risky, and strategic investors, which should have an allocation to stocks, long-term equities. The economy is rebounding, albeit slowly, and the Fed is giving us very little choice other than to be in stocks for long-term investors.
Yeah, and I want to be clear. I mean, like Hertz and Whiting Petroleum and others that have filed for bankruptcy, that is gambling, and I say that with conviction because you're literally in the hands of the bankruptcy courts when you're betting on equity. I mean, you don't know how it's going to necessarily turn out because you're at the super bottom of that creditor food chain here, Mark. But do you think that kind of behavior puts the macro market, the good companies, the leave your home trade, does it put those companies and markets at risk, or is it kind of a sideshow?
I think it's mostly a sideshow at this point. Look, are good reasons to bid up large cap tech. There is a legitimate stay-at-home trade. Even though I know we're opening up, I think the online economy is here to stay. I think that the industries and technologies that service the big names we know, it's not just Amazon that's involved in the shop from home. It's chip makers and infrastructure. It's industries reopening where elective surgeries and medical technologies are legitimate areas to invest. It's those warehouse REITs that service companies like Target and Walmart and Amazon and their shop from home entities. So if you look and do real analysis, you will find companies, communication services, the big Verizons and AT&Ts with 4% and 5% dividend yield. Those are still relatively solid areas of the market where people can not only get the stay-at-home trade and benefit from technology, but these are companies that are going to survive this economic cycle, the next, build franchise value, accumulate and gain market share, and they have reasonable valuations right now, especially given low interest rates. So separate the froth and the frothy names you mentioned from strong areas
Yeah.
of the economy that are part of the core.